Hello financial fans, welcome back to another stock analysis. Today we'll be covering Home Depot, stock ticker HD. Home Depot is a home improvement retail company that operates a chain of stores across the United States, Canada and Mexico. The company was founded in 1978 and has since grown to become one of the largest home improvement retailers in the world. The Home Depot offers a wide range of products and services for home improvement and construction, including tools, building materials, hardware, appliances, and services such as installation and repair. The company has a large brick-and-mortar presence with over 2,000 stores across North America, as well as a strong online presence, offering customers the ability to shop for products and services online. Home Depot's goal is to provide customers with everything they need for their home improvement projects from start to finish and offer exceptional customer service and expertise to help customers complete their projects successfully. They're currently sitting at a $322.6 billion market cap, and in 2021 they generated a revenue of $151.2 billion. Dividend yield is currently sitting at 2.4%. 40% of their revenue is generated through building materials, 28% from decor, 32% from hardlines. To determine the final valuation of the company, we'll be using a margin of safety. Margin of safety will be based on the financial ratios, the financial health, and the growth of the company. And we'll be using a standard margin of safety of 25% that can never be below 0%. Margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. Margin of safety. First two metrics that we'll look at are the EBIT growth and the margin growth. EBIT has gone up, going from $7.9 billion in 2013 to $23.3 billion in 2022. The average EBIT growth over this period was 13% average annually, which is a 5% deduction from a margin of safety. Margin has also gone up, going from 10.5% in 2013 to 15.4% in 2022. The average margin growth was 4.4%, meaning another 5% deduction from a margin of safety. Next two ratios are the dividend growth and the payout ratio. Dividends have gone up, going from $1 a share annually in 2011 to $7.60 a share annually in 2022. The average growth in dividends during this period was 20.5%, meaning a 10% deduction from a margin of safety. This with a 44.3% payout ratio, meaning there's still room left for them to increase their dividends further. In this case, it's no change in the margin of safety. Final ratios that we'll look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Home Depot, this is just over 1.5 years. In this case, a 168% debt to EBITDA ratio, meaning no change in the margin of safety. The return on invested capital is sitting at a very nice 13.2%, meaning a 5% deduction from margin of safety. Looking very good so far for Home Depot. Let's go look at the valuation models next to determine the intrinsic value of Home Depot. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2013 to 2022. The average growth in free cash flow during this period was 11.6%, and I'm projecting an expected growth rate free cash flow of 9% annually, next 10 years. With this percentage, we can determine the future free cash flow for Home Depot and determine a terminal year valuation, using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $380.9 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, giving us with an equity value of $337 billion. To get a discounted cash flow price per share, we just have to divide this by the amount of shares outstanding, giving us with a price per share out of this model of $330.39, which is a 4.38% upside from current price. Second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from the 4 years ago to the current year. The average growth rate annually in dividends during this period was 16.87%, and I'm projecting an expected growth rate in dividends of 7%. And we'll be using a discount rate of 8.5% again in this valuation model, just like the previous one. This gives us a dividend discount model price per share of $542.13, which is a 71.27% upside from this point. Third model that we'll be using is Graham's revised valuation formula. In this model, we'll be looking at the earnings per share that Home Depot is generating, growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds. And we'll be going by the theory that a PE of a company with no growth is 7. At all of these metrics, we get a fair value of $203.71, and with the current price of $316.54, this is a 35.4% downside from the current price. Fourth model that we use is the multiple valuation. This model will be looking at similar companies, Home Depot, look at their stock price and the earnings per share. This way we can determine the average PE multiple in the industry. This case is 23.63. All that's left to do to get a fair value is to multiply by the earnings per share that Home Depot is generating, which is $16.59 a share, leaving us with a fair value of $391.94, which is almost a 24% upside from the current price out of this. The final model that we'll be using is the mean reversion theory. This model, we go by the theory that a company will always trade above or below its mean, and the metrics that we'll be using to determine this is the dividend yield and the PE ratio. In this case, I've imported the dividend yield history of Home Depot over the last 5 years. The average yield during this period was 2.30%, and the current yield is 2.29%, meaning it's almost exactly at the current mean. PE ratio, however, is a little bit lower currently than what it was in the past 5 years on average. This indicates that the company is slightly undervalued out of this one. Leaves us with a fair value of $328.14, which is an upside of 3.67% from this point. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, multiple valuation, and the mean reversion theory prices per share, leaving us with an average of $359.26. Our margin of safety we have determined earlier using a standard margin of safety of 25%, deducting about 5% for the EBIT growth, another 5% for the margin growth, another 5% for the return on invested capital, another 10% dividend growth, leaving us margin of safety of 0%, which means no margin of safety at all. It means the fair value is the same out of the averages as the models, leaving us with a fair value of $359.26, which is a 13.5% upside from the current price. So in this case, it would buy. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.